Had I known in the last downturn, curve what I know today, I would not be sitting here in front of you guys. I would be sitting someplace on a beach having a Bahama Mama. So what we are trying to do now today is go through what happened in that last downturn. How did I leverage being a broke 9-to-5er and in less than 2 years have a $6 million portfolio that netted about $5.5 million. So we're going to talk about what that was and how you can weaponize those strategies in this upcoming downturn to where you don't have to work for more than the next maybe 5 or 7 years. Stick around and we're going to get to it on the other side.
Teach me something.
What's up, YouTube, Facebook world? How are you? What's up, Daniel?
Oh man, it's my Monday morning right here.
It's Monday morning.
that long weekend kind of gave me the time to sit back and enjoy the family that I needed. So
yeah, that's really good. You seem more rested today.
yeah, it was a good weekend. Got to spend a lot of time with the kiddos. So
good.
If y'all are watching right now, hey Tyler, hey Zyla, hey my wife Miranda, thank you all. Thank you for being there.
That's awesome. Hope you guys had a good Labor Day weekend as well. We are continuing on in a series we're going to be handling over this next probably 4 to 6 more weeks of understanding what we're looking at in the current market, understanding that we don't have crystal balls. We're not fortune tellers. We don't know exactly what everything's going to look like, but we've got information and knowledge now that can be weaponized into some ridiculous portfolios. And you guys, having this video and this series, have resources that Daniel and Grant didn't have when we got into it.
I can guarantee you, like you were saying up front, if I knew then what I knew now, it would be a totally different world in front of me. Like, I am by no means ashamed of where I made it. Like, I was still, even with the lack of knowledge in the last downturn, able to establish myself a solid seven-figure net worth. I was still been in the 8 to 9 figure net worth just because of the knowledge that I have now of what was occurring at that time.
Yep. And I know some dudes that started when we started, that kind of 2011, 2012 time frame, which I think is when you got in, right? That's when I got in.
I got in heavy and hard around 2012 and started dipping my toe 2008.
Okay.
So my first acquisition was 2008.
Okay.
Between 2008 to 12, I did like 6 transactions, so
Awesome.
not a lot.
Yeah.
But those transactions gave me the seed capital to move forward.
Awesome. Perfect. Yeah, so I know a couple of dudes that started and fortunately they were just in different situations. They handled things a little bit differently. They handled things more like what I would handle in this next turn. And these guys are I mean, I don't want to, maybe there's
Solid
too many
8
clinch,
figures.
but yeah, we're talking 8, 9 figure net worths. You know what I mean? And I mean that. It's crazy. And like you would have no idea. You know what I mean? Like
Really,
that's the thing. They're super chill. You would have no idea. So what we're gonna do is let's jump over to this real estate cycle stages graphic that we brought up last week. We want to go back over this and just make sure that everybody kind of understands what Daniel went over last week, which was a phenomenal episode on how this graphic works. So what we've been seeing since 2015, if you got into 2015, you've been looking at like this right here, okay? Would you agree with that? Like stage 4 early recovery was probably 2015?
I would say that stage 4 early recovery was probably 11, 12.
Okay.
That's my, because we hit 8 and then we had probably about
That's
18
true.
to 24
That's true.
months of down.
Yeah.
So I would say that 08 was early downturn stage 1, 08, 09, and then around 2010, 11 we started stabilizing, and then 12, 13, 14, 15 was 4, 5, 6.
Yeah.
That's kind of my opinion of our
Cool.
last cycle.
So one of the things that I want you guys to gather from this is that there's, again, we don't have crystal balls. There's no exact science to like, well, it was January 14th of 2000 that stage whatever start. These are all very blurred lines between, but we need to understand how the general outlook of these cycles works if we're going to be able to have a wide eye and a wide lens to know how to what's the word I'm looking?
I'm not going to say
advantage of?
predict the future, but if you know what part and phase of the cycle you're in, you're going to have a better understanding of what strategies you need to be implementing to take the most advantage of the current situation.
Right.
If you're like, I'm a flipper and you're in stage 1, stage 2, you're going to get destroyed. You're not wanting to flip in stage 1, stage 2. So the primary thing we're trying to discuss right now is, last episode we talked about stage 1, 2, 3, 4, 5, 6, all of them, and kind of the holistic approach to how we got to where we're at.
Right.
This show, we want to discuss specifically stage 1, stage 2,
Right.
because this is where we're headed, and this is where you really shine.
Exactly. So where we feel like we are is right here, right where this tick is. Daniel and I both kind of agree. Here's one of the things that, and again, I toot this too much, talk about this too much, but I've got a lot of high-end dudes, a lot of dudes who have done 5, 6, 7, 800 deals, some of which are doing 200, 300 a month or a year, some of which are doing 1,000 plus a year, who are coming to me right now saying, dude, it's turned. We're screwed.
So why is this? Why would this be happening? And I'm asking this to draw more information out of you.
So so here's the thing.
I'll answer it for you.
Well, so everything relates ultimately to a supply and demand, right? And that's why you see a fluctuation, because there will never be a perfect, think about it like driving in a lane, right? You are never exactly perfect right in the middle of that lane for 6 miles, okay? You just naturally see that you're getting too close to one side, and you're going to kind of swerve over to the left side, and you can see you're getting too close to that side, and you kind of swerve back. It's very minor, but it happens. Straight lines are impossible, right? Similarly with a market, we are going to see an oversupply and what do you call it, a resistance and
Support and resistance.
Support and a resistance, where things are going to fluctuate, always kind of hovering that center ground, right? And so expound on that. Why are we here?
We are here right now because the people that are doing those 300, 500, 600,000 deals are starting to see that their cost per deal is going up drastically, that they're taking more effort to get a deal done, and that they're starting to see that they're not enjoying it as much as it used to be.
Yeah.
Why is that? It's because they have been performing the last 4 to 5 years in an uptrending market, which is easy for anyone to win in.
Right.
If you got in 2012 and you knew what you were doing, I didn't know what I was doing, and that's why I'm sitting here right now explaining to you. You got in 2010, 11, 12, knowing what you were doing. Right about now, you should be super rich.
Yeah.
Well, what we're finding is that these people that have been doing this made a ton of money, and now they're getting to the end and they're like, I'm not making the money I was making before, and they were trying to figure out what to do next. And what they're seeing is that this is starting to contract. We are starting to have problems. I better be prepared for what to do next. And that's why they're contacting you, is because they've been through enough of the cycles that they know what's about to happen, and you dominated in this last downturn through a, I'm not going to discredit you at any chance, you just entered at the right time with the right mentor, and you dominated it and killed it. Like, you just went out. I remember whenever I sought you out as a mentor, you were closing like 15 deals a month of your own portfolio, and then through Texas Pride closing numerous more.
Yeah.
So you have the knowledge that we need for this next downturn.
Exactly.
Let's talk about that.
Yeah.
What's happening?
So when we get into these turns, and when you're saying why did we get here, I know why we're here, and that I thought you meant like overall market, like what caused this.
Oh, my bad.
We don't know necessarily overall market, but we can recognize, right? So we do recognize this is what we need to look at. So let's go back to this graphic. Let's look at these this yellow line. This yellow line here, if you're not aware of what's happening here, this yellow line represents our property values, okay? So what happens is credit is copious, right? There's lots of credit. It's easy to get it. And people start buying houses when they feel comfortable getting credit. They feel like the economy's good, so you got people buying houses, buying houses, buying houses, buying houses, okay? Now, this section right here at peak is a 2-ish to 4-ish year section typically, okay? So what we are looking at when we start getting into early downturns, stage 1, is we all know, and I hate this about ourselves, but it's true, is we're sheep. We follow. Everybody likes to freak out. So when the market turned in 2015 was when it, like, quarter 1 2015, our days on market here in the DFW area went from 6 months on the market to 6 days on the market. Literally, I'm not exaggerating. And really, all it really was enough people told their friend, hey, I made an offer on a house and somebody else got it before I did. And then everybody flipped their crap and went and bought houses because, oh my gosh, you can't buy a house. I have to go buy a house now.
The bidding wars were going crazy. We started seeing prices go up, and that's been what we've been sitting in for the last 4 or 5 years.
Yeah, it was so crazy. And so now that that's cooled off, what we're going to start seeing is now the next thing that you're going to start hearing is, oh, did you know that the market, it's a buyer's market now. Now's a terrible time to sell, blah, 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 right? So you're going to start getting these people. Well, that doesn't mean that people's life situations don't keep changing. That doesn't mean that people don't want to sell houses. But what it does actually cause to happen is just like in the stock market, when you start to see these downturns and when the talking heads start to talk about a downturn, everyone wants to get out before it's too late, okay? So you start seeing these reactionary people who, it's kind of the whole hire slow, fire fast mentality. People who waited because they're like, well, you know, I'm not sure where the market. They wait, they buy. Then they start hearing that it's time, you know, well, I better get out now. So what you start running into is people who bought on one side of that curve start trying to sell on the other side of that curve, okay? Now this period may be 2-ish years, okay? So what we're looking at is somebody who's had just enough time to live in their house and get used to it, just enough time for the new to worn off, and just enough time to freak out and want to sell it, and just enough time to where they don't have the equity to sell it. This right here is why this section, early downturn, really moving all the way down into full downturn, is creative financing territory. That is where I was able to come in and leverage problem-solving skills for somebody's money problem.
So let me apply this to anybody that's out there watching right now. Like if you're just now getting in, creative financing might seem like a pie-in-the-sky activity. It is really nothing more than just gaining the knowledge you need to apply it. But if you're out there trying to wholesale right now, and let's say you're only getting 1 contract out of every 6 appointments, this upcoming market where we're turning down, being able to apply creative financing to it, because you're not going to find those deeply discounted deals because the market's correcting. Everybody that's just bought trying to get out doesn't have the equity to sell. You're going to have to figure out what to do in these markets, and that's where the creative financing piece comes in, and that's where you really shine. So if you're wholesaling, add this to your tool belt. Find somebody in your local marketplace that understands subject to that you can partner up and work with, so that way you can take these deals down as you're moving forward. You got in right at this last downturn, and you really just came in and just bought up hundreds of properties.
So here's where my situation arose, right? My situation arose in that I was working an IT job, making okay money, right? Decent money. I was making $48,000 a year, which is not, you know, it's not the end of the world, but as a 25-year-old dude, 50 grand is good, right? I had about $8,000 in my 401k because, you know, we're taught that 401ks are the way to retirement. And it was time to get out. It was time to do real estate. So my path, I'll say my path in a short story, and then we'll apply this to, again, weaponizing it for this next market. My path was I bought a duplex. I took out a loan against my 401k for $6,800, bought a $192,000 duplex that was already fixed up, lived in half, rented half, okay? That was an FHA loan, got it 3.5%, which was nice. Again, credit was available, or 3.5, 30-year loan. So I was able to rent my other piece and basically cover 90% of my expenses for my living. Then, from there, I was out of money. I used my money, my 401k. I didn't have any money in the bank or anything like that. But at that point in time, it was starting to realize by Googling how do you buy houses without any money that creative financing was the way to go, right? So I started leveraging my knowledge, my ability to go out and, my time, my ability to go out and do stuff for somebody else's knowledge. Now, you already have my knowledge. That's one of the things. This is a resource that I did not have getting in. This is a resource that Daniel did not have getting in. That's one of the cool things of what you've got with the Propelio Academy, with Propelio TV, is that you have resources that we did not have. You should do better. in this next cycle.
We're giving you the last 10 years of our information right here, right now. We're giving you 10 years of solid, hey, we've seen the cycle. Hey, we've seen how this works. We've put together businesses during these cycles that performed. And we're also coming back to you saying, now that we've put together those businesses during those cycles that performed, we're going to share with you what we learned and what we did wrong that would have allowed us to perform even better.
So here's one of the things that I learned in my last downturn cycle. Is that people sell their houses sub 2 who've had their house somewhere between 2 and 8 years. If you look at a plot chart where it's like you put all of it, I'm going to have a large density plot area on the 2-year mark. I'm going to have a large density plot area on the 8-year mark. I don't really know why on the 8-year mark. I think that it's because most people sell their houses between 5 and 8 years. But for whatever reason, I get
the newness wears off.
Yeah, that newness wears off, and it's just there's a large plot area for sub 2s in that range, right? So there's a hint for you if you're trying to find some lists. What we were able to do is understand that the value of having a tool belt is immense, right? So I got in and I focused solely on subject to creative financing. I didn't do a wholesale deal until about my 35th deal. Okay, I already had employees. I already had a system running. We were already taking down consistent deals. And a funny story to it is that, so like one of my employees who was handling all this stuff, you know, we've done 35-ish owner finance deals, sub 2. We're taking over complicated situations, leveraging. I didn't have any money. We'll talk about in the next section. I'm going to talk about how you can leverage option periods in this downturn, because that was a big part of my ability to get success. So we do a wholesale deal, and we were going to get like a $28,000 assignment fee for this. So I turned it into my admin, and I was like, okay, here we go. Let's, send this over to closing, blah, blah, blah. And she's like, okay, so what do I do next? I'm like, no, that's it. Like, we just get $28,000 now. And she's like,
she'd never done a wholesale transaction.
She'd never done a wholesale transaction.
She's like, what, $28,000 for what? Yeah.
She was like, why are we not doing this more? I'm like, well, there's more to the story,
okay.
Right? There's more to the story. We need to understand what we have in front of us is the ability to build a legacy. What we have coming up in this next couple of years is your portfolio build. And I know that I'm doing a lot of stuff right now, like we talked about last week, specifically because of what we started out saying. If we knew now, or then what we knew now, it would be a completely different story. And we do know now what we have into a market that is going into a then, so it's time to weaponize it.
I'm excited about this.
Super pumped.
I truly am excited about this. And can I stop to ask you just a couple questions to draw it out of you? Mm-hmm. And I don't know how deep you want to get into this. You popped in around 2012.
Yeah.
All right. Between 2012 and 2015, can you give me an accurate, semi-accurate guess as to how many transactions you performed?
Yes,
on your personal portfolio.
And this is one of the big reasons, and I'm happy to give that to you. This is one of the big reasons why I get so tired of people talking about how they need to do 50 or 60 deals a year. Between 2012, so I bought my duplex February 2012.
Okay.
I quit my job November of 2012. I went full-time into real estate. I had only done 3 deals at that point in time, my duplex and 2 sub-2s. My second sub-2 hadn't closed yet. When I quit in November, it wasn't set to close till December. I leveraged that sub-2 as part of the reason as to how I got the partnership with Scott. Hey, let me put this deal into, we'll split it out. Mm-hmm. Let's work together, blah, blah, blah. So 3 deals by December of 2012. Between January of 2013 and January of 2015, so in a 2-year time frame, I did approximately 100 deals, 115 deals total.
Now let me keep drawing questions out of this. When we talk to a wholesaler and we say, hey, how many deals are you going to do? That year you did 60. Well, those 60 deals you did that year are gone. The next year you have to do 60 more. Those 115-ish deals you did, how many of those 115-ish deals are still there 3 months down the road, 4 months down the road? They're all in your portfolio. You owned an asset. Yep. You didn't flip paper. You owned an asset. And that's why I did a couple shows a while back saying, stop wholesaling. You're an employee. You're never going to stop working as a wholesaler. You need to learn how to start acquiring assets. And you skipped the whole wholesaling thing and you just went straight into creative financing because you were in the right market cycle that dominated it. Right. And over the course of 2 years, you held 115 assets in your portfolio.
Well, and I didn't even hold 115. About 25 to 30 of those were flips or wholesales
Okay.
or this or that. So let's go back to the graph here. Let's or to the iPad here. Here's something I want to show you guys. This is a very important philosophy that I need you to understand. You've got to have a tool belt. Okay, different deals tell you how to make money on that deal. So this is one way to look at it that I think is a great way to analyze. Again, letting the deal tell you how to make money on it. If you get a deal at 0 to 75 cents on the dollar, you can flip that deal. If you can get a deal 75 to 80 cents on a dollar, there's a good chance you can wholesale it. 75 to 82, it's okay to hold. I'm not necessarily recommending it, but it's okay to hold. 82 to 105, that's an owner finance deal all day. Short sales are 105 plus, and that's kind of how those work. Now, pay attention to that right column. You got to look at your today and your tomorrow money. Net worth doesn't buy you groceries, right? So if you go into this, you're going to understand there's going to be a period of time where you're a millionaire, you're not making very much money. Okay? That happens. That happens to the guys who have a long-term outlook because we apply all of our cash back into buying more assets and you've got net worth out the butt, but you're not really pulling in a bunch of money today. So, again, net worth doesn't buy groceries. So maybe you need a flip every so once in a while. That's today money that you get tomorrow. You got to wait some time for it. Wholesale, straight up today money. Transactional, you get a one-time payoff, that's it. Holding, tomorrow money. You're not making money up front. If you do like a rental, for instance, you don't get a large chunk up front. You might be getting $300-400 a month, hopefully net, but it's most likely not.
Reserves,
Yeah.
escrow.
So it's all tomorrow money. Owner financing, the beautiful thing about that is that you get a 10% down payment, so you're getting your today money, which is usually akin to what you might have gotten on a wholesale fee. And you get your tomorrow money, which is true net money. And then short sales are today money, one-time transaction
You get next year.
that you get next year, right? So understanding this, right? Understanding the fact of, like I said earlier, I didn't do a wholesale deal until my 35th deal or so, right? And then we started taking down a little bit more today money because we kind of saw that need for, hey, wait a minute, I got a net worth, but I'm not pulling in cash.
I'm a firm believer that there are anomalies that occur, but to really grow and succeed as a real estate investor, you need both today money and tomorrow money. Because if all you focus on is tomorrow money, your today money dries up.
Yep.
And if all you focus on is your today money, your tomorrow money never comes.
Right.
So you really need a blend of both strategies. And that's why the tool belt is really important, that you're constantly remembering that, you know what, I need cash to keep my assets alive, and I need assets to stay alive tomorrow.
Absolutely.
So you really need a blend of both.
So to finish up this question before we go to our break, that 2-year period, I only did 115-ish deals, right? 25, 30 of those were, well, actually not even that much. Probably maybe 15 or 20 of them were today money deals, right? Did some flips, did some burnouts, did some wholesales, did stuff like that, get some today money in. All in all, if you add all that up, if I look at what that portfolio has done for me over this last cycle period of just those properties, okay? And I'm not counting my duplex because, even though that duplex has performed very well for me, actually. I bought it for $192. It's worth $375 today. I'm netting, after all of the expenses and everything, I'm netting $1,200 to $1,500 a month on cash flow on that guy. I'm not even counting that. I'm only counting those properties I bought from 2013 January to 2015 January. That $6 million portfolio has netted about $5.5 million for me.
That is amazing. And you did that within your first 3 years as a real estate investor. You quit your job after your third deal after only being in the industry for 4 or 5 months.
Yep.
Put your back up against the wall, went out there, kicked some ass. Now, this was a rough time. I was right next to you during this time. This was like eating Campbell's soup on 4 times a day, working from the time you got up in the morning till the time that the sun went down.
Yeah.
7 days a week, Christmas, Thanksgiving, holidays. You were working around the clock, but in 3 years, you were able to establish yourself as a millionaire and sit back and not relax and stop, but go forward in life with an understanding of, I have figured this out. Now it's just time to scale.
Absolutely.
So for those that are watching right now, that is not an impossible timeline. And it's definitely not an impossible timeline if you understand the market curves and when to jump in and jump out depending upon your asset strategies or your acquisition strategies. And I really think that it's important to highlight what you accomplished during that period.
And I think, to your point too, it is very important to highlight, look, you know, like the commercials say, results not typical, right? God opened a lot of doors for me. This is not what everybody gets that gets in. There's a huge turnover in real estate, and I'm tired of educators completely ignoring the aspect of luck. There is a certain aspect of luck that gets into this business.
I believe the harder you work, the luckier you get.
But there is truth to that, right? There is exactly that. So I literally worked. This is not so that I can get good credit in front of you guys. This is literal, actual. I literally worked an average of 13 to 15 hours a day, 7 days a week for my first 20 months in the business. Okay? That's what it took to get that portfolio.
So if you're out there watching right now and you're putting in 4 or 5 hours a week, I understand that's what you got, but what he did is very similar to what I did. When I realized the opportunity was there, I put my back against the wall. I sold off everything, reduced my expenses as much as I possibly could, and put in the 80, 90, 100, 120, 130 hour weeks for months and months and months, because that's what it took to get it off the ground.
Absolutely. So I hope you guys understand that. We'll talk a little bit more rah-rah and what it actually looks like work-wise. I hope we've given you enough of a tease to say, look, I did this not knowing what the hell I was doing. Built, you know, again, a net of 5.5 off of 115 properties.
And you started out with no money in your back pocket.
And I had $0 in my back pocket, and I had zero resources like this to teach. So I hope that that's enticing enough for you. Stick around. When we get back, we're going to talk a little bit about more details on what it really looks like to do that. How do you actually transact this? How do you actually structure your deal in a way that you don't have to put your own money up on it, where you can still make that income coming into your pocket? So stick around. We'll be right back.
Hold on. Before we go to the break, while we're on break, I'd like y'all to do one quick favor for me. Propelio has just released our mobile app. It's Propelio Mobile. It's available on the iPhone or Android platforms. Go out there to your stores. If you would, please download that app for us. It's Propelio Mobile. It'll allow you to go through, drive for dollars, trace all your previous drives, pin property, send direct mail, skip trace. It'll allow you to do all those types of things. So if you're out doing any sort of driving for dollars applications, go out there and download Propelio Mobile on both the iPhone and the Android. And when you come back from the break, let us know what you think about it, and write us a review after you've tried it out for a while if you like it.
It's really good.
Go out there and check it out. See you right after the break.
Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at Propelio.com.
You want to buy more houses? Here's Dar and his wife after only 2 weeks of being my mentor student. And here's Brady after paying attention to all our online videos and attending all the live Q&As. You want to buy more houses? 3 steps. Sign up at creativecashflow.com/memberships, watch all the videos, attend the live Q&As, and then send me a photo with you and your sweet, sweet new contracts. creativecashflow.com, helping you buy more houses for one low price of only
All right, I want to reiterate that if you did not go out and download the app, guys, I was blown away. I went out and looked at the app. I was like, man, this is freaking cool. It does some really cool stuff for you. And the leads lists that are available from Propelio, national comps, that's huge. That's big. I'm personally excited because I'm going to be doing a national push over this next 18 months. I'm going to start investing because of, again, we're putting our money where our mouth is. We are going to be investing nationwide because this curve is not just a Texas curve. This curve is a national curve. So if you are someplace that is not Texas or Dallas, it's time. Go sign up for Propelio. Propelio.com. You can get your comps, you can get your leads list, and the leads that are being provided now are stupid.
And a turnkey website.
Turnkey website, all that. It's stupid crazy.
There's a lot of value there. Go check it out.
So what we promised when we came back was that we were going to talk about a little bit more details on practicality on how does this work? How does this work? How do you take that? You know, I told you the outline. I didn't have any money. I cashed out my $8,000 401k. So here's the deal. So I had $9,000 in my 401k. I bought the house with $6,700 of that, $6,800 of that. When I quit, I cashed out the rest, took a huge hit on my taxes. I ended up having like, you know, a few $1,000, $3,000, $5,000, something like that to live on for the next 6 months to make this work. I'm not just saying be foolhardy, quit your job. Be smart about it, right? Understand what you're, but to his point, and it's funny, if anybody's followed me on Facebook for a while, so I moved offices about 1.5 years ago at this point in time, maybe 2. And as I was moving offices, there was a crate under my table I hadn't looked at in a long time, and it was cup of noodles and chunky soup. And man, it gave me a throwback because that was it. That was what I had. You know, we were eating cup of noodles every day and surviving.
That's exactly how I got into it. And most of the people that I've seen that progress down this path and achieve a level of success that most do not achieve are the ones that cut bait and just dive deep in and say, this is my only option. There's no other way out than this.
Jump and the net will appear. So we are not telling you, go quit your job and ignore all of good. But you do have to believe in yourself, and you do have to surround yourself with the right resources, right? I understood the philosophy behind the owner financing stuff, and after I had contracted 2 deals that way with sub 2, I said, holy crap, these people are giving me their house. I don't have to put money up for it, and I'm turning around and making money on this. My job is getting in the way of me making money.
Let's talk about that. Let's talk about sub 2. Sub 2, I think you and I both agree, is an acquisition strategy. Yep. We don't really want to sell sub 2. Nope. We want to buy sub 2.
Buy sub 2, you sell with a rep. Never do the other way.
So let's talk with me about that for a second. We're going into phase 1 of a downturn. We're starting to move down. On the rise up, credit is abundant. It's easy to get a loan. Whenever the market starts turning, banks start backing off. Banks are not wanting to loan as much capital anymore. How is this working? How is Grant Kemp sitting down with Mr. and Mrs. Homeowner at their kitchen table and saying, hey, I know you bought your house a year ago for $225,000, but right now on the market it's only worth about $210,000, and I know that you don't want to own this house anymore. What I'm going to need you to do, Mr. or Mrs. Homeowner, is just give me the title to your house, but I'm going to leave the bank loan in your name. And what I do is I'll promise moving forward, I'll make those payments for you. How is Mr. Grant Kemp, that has now purchased a duplex and has now convinced 2 other people that he is the guy they need to give their title to the house to? He's not even buying it. It's not like Grant's showing up to somebody saying, hey, let me give you $5,000 for the title to your house. I remember the first time I sat down with you, you're like, dude, what are you offering them money for? Just get them to give you the house. They will give it to you. And I'm like, are you kidding? He's like, no, do not offer them any money at all. When you really think about it, it doesn't make sense to offer them money. The house is worth $215,000. They owe $225,000. What makes them think they're going to get any money out of it? What they're getting out of the transaction is someone to make that payment for them because they can no longer do it. How were you sitting down, Mr. I've bought a duplex, and convincing people that giving you the title to their home is the right thing to do?
So here's one of the things this is the best advice I've ever been given, okay? And this was in the context of due on sale clause when I asked about it. It was by a guy named Sean McQuistion. He's done 10,000 transactions. I mean,
dude's a powerhouse.
He's a powerhouse. And I was asking him because everybody was always saying no to me because of due on sale whenever I was either buying or selling. And he said,
what's due on sale?
Due on sale says that if you sell your property, the bank has the option, not the obligation, to ask for the remainder of that debt to be paid off at any point in time. Reality is that it just doesn't happen in the real world. But that's the due on sale. If you want to know more about it, go to propelio.com/academy. I actually have a video on there that talks specifically about due on sale clause and how to address that. I also have an entire module that you guys will be blown away with. I'm very conceited here, but there is not another module on the internet, paid or not, that's going to teach you sub 2 in the detailed way that you get off of the Propelio Academy.
36 videos for free 99.
For free 99. So I'm sitting in front of people. I can't get to a yes. The advice I get from Sean was some of the best. I felt like he needed to be hunched over with a cane. You know what I mean? I was like, this dude is a freaking wizard. He goes, Grant, if you are consistently getting a no for the same reason, it is most likely it's a problem that you have with what you're saying and not a problem that they have with what you're saying. And it was like, completely changed my brain, okay? So here's the thing, and I'm glad that you remembered me beating you up about that, because I also had to beat up my partner at the time, Ronnie.
I remember.
I am a big believer. We do not pay for these houses. They give them to us. What do we give them? We give them not going to foreclosure. We give them making their credit pay or making their payments on time. We give them not having to deal with this property anymore. That's what we're giving them. I've said this many times, many ways. There is more than one way to get paid in real estate, okay? Too many people focus only on dollars. You can get paid in lifestyle, you can get paid in dollars. There's a lot of different ways you can get paid. We have to apply that to there's a lot of different ways that we can pay as well, right? So when we sit in front of somebody, we have to understand that human being's situation. We have to understand what they're dealing with and what they need as a solution. So the great thing about this market, what we're about to see, okay, there are, 75, 100 people watching right now. There's going to be a few thousand people that see this by the end of the week. If you extrapolate that out into how many people are buying houses in your market, it's this much. There are this many people who are getting the front edge advice that you're getting right now. What I'm saying here, 95+% of the properties I have ever purchased had been told no by a cash buyer before I got there.
I believe that was a big part of y'all's campaign because I was watching what y'all were doing. Y'all were dropping massive amounts of bandit signs all over the place. And y'all would start, I remember Ronnie Walker, sitting down with Ronnie Walker talking about the bandit signs. If we're doing a 10 by 10 spread and we're going down to Main Street, bandit sign, bandit sign, bandit sign, he would start developing conversations with people. Bandit sign number 1 is like, we'll buy your house fast, take over payments, whatever. The next sign would say like, has somebody else already told you no? We can buy it top dollar. And then the next sign would be like, if somebody else was offering you too little, I can pay you twice as much. And like y'all were getting really creative with your signs, but what y'all were doing is just going out there and finding all of these people. Because when we start hitting that curve, the number of people that have equity diminishes quickly. And when you have the last 5 years of people that have bought houses that are now trying to get rid of them and have no way out, sub 2 becomes a prevalent acquisition model that dominates over all else. How am I going to go in there and wholesale that house? How am I going to go in there and cash offer? How am I going to go in there and flip? It's not going to happen. So if you don't know sub 2 when the market's going down, you're dead. Top side of the market. I believe shorts and sub 2 wraps, not even shorts, sub 2 wraps is where we need to be at the top side of the market. You did a ton of those. Sub 2 is an acquisition model. Wraps is a disposition model. What is the difference between sub 2 and a wrap?
A sub 2 is short for I'm going to buy your house subject to the underlying lien staying in place as is, right? You owe 100, I'm buying it for 100, and I'm going to keep paying that.
I'm just going to start making your payments for you.
A wrap is, hey, he wants to pay me 150 for it. So I'm gonna buy yours for 100. I'm gonna pay your payments on your behalf for 100. He's gonna pay me a higher interest rate, a higher principal for a longer period of time than I'm paying that. I have wrapped his financing around this subject.
Now there's a deep explanation of that on the Academy at creativecashflow.com. If you haven't seen creativecashflow.com yet, that is Grant Kemp's resource where he provides not only subject to and creative financing strategies, he is a master negotiator. This guy cleans out the house whenever he goes like 4 out of 5 appointments you walk away with the contract on. And those aren't hypothetical numbers. Those are real documented numbers. So stream negotiating stuff over there at creativecashflow.com. But when we first hit that turn, we start dropping down subject to wraps.
So we're sitting in front of that person, right, who can't sell otherwise. This is beautiful for us. Our job as negotiators, and you'll see this in the negotiations module that's on creativecashflow.com, which I do encourage you guys to do. Check that out. We got a few CCF members here today. David's in our mastermind. We've got a couple other people watching. Anyway, when you're sitting in front of them, see, I'm a big believer in honesty. Just period. One of our core values is that we're going to do the right thing, especially when it's not in our favor. I repeat that a lot because I want you guys to adopt a similar core value. But it's somewhat self-serving too, because honesty wins. And if it doesn't, then you know that you went the right road anyway, right? So when I'm sitting in front of a seller, I'm just very real with them. If I know I can take this deal down, I'm telling them I can take this deal down. But when we're in this market, we're going to use all of the talking heads. You know what's going to be the best news for you? It's when you turn on CNN and you hear, is the market crashing? That is, when the moment you hear that,
the best news ever.
Is the best news you're going to hear. Because that means Joe Homeowner just heard that too. Okay? So we're going to leverage the market's freak out and the sheeple mentality that we have for our benefit. And they know that they're in a tough spot. they know that they have a property that is worth what it's worth, or that they owe what it's worth, right? And so we're going to leverage that. We don't have to overextend ourselves. This is why I was saying if it's a problem that, if you're getting no, most likely it's a problem that you have, because I need everyone watching this video today to shift their mentality, okay? You have to throw away, we give people money for houses, and you have to adopt, people give me houses for the opportunity for me to make money. That's what you are going to do from now on. So when we sit in front of a seller, our pitch is, you can't sell any other way. I am your best option. I don't even know if I can do it. So we're going to go under a 60 or 90-day option period where I'm going to try and see if I can make money on this deal. And if I can make money on this deal, then I will tell you I'm ready to close, and we will go to closing, and I will acquire your house, and then 2 hours later, I will sell your house and be done. I've not put a single dollar of my own money in. I'm not giving you anything, and the down payment that comes in from the sales side is covering any arrearages and any agent's fees and any closing costs, zero net out of my pocket, and now we have cash flow coming in.
And I remember having those conference calls with you several of times through our mentorship when we first got started. I'd get on the phone with a seller, and they're like, you know, XYZ, and I'm like, how about you just give me their house? Well, let me get you on the phone with Grant. And I would just sit back and I'd listen to you, and I'd start. That's how I learned how to get through it, because I listened to you talking to these people, and I was like, damn, it really was that easy. Just like, give me your house. Yep. Because the situation they're in is they can no longer afford their payment, and they can't afford to sell it. They can't do either. They don't have equity to sell it, and they don't have money to pay for it, but they have to get rid of it. So their choice really is let somebody else pay for it for them, or let it go to auction. There really is not much of a choice. So I'm going to try my best to just run through, recap this, and go through as simple-minded as I am and explain this the way I can understand it. Yeah. When the market starts going down and somebody wants to sell their house, they have no equity. So they can't pay an agent. They can't bring money to the closing table to close because they don't have the money. So what do they get stuck with? They either have to go to foreclosure, or they have to find somebody that's willing to make payments for them. That's where we come in. That's where real estate investors come in. We will start making payments on this person's behalf. All right, well, now what happens if I don't have massive amounts of money to go in and correct the arrears, and I don't have the money to come in and start making the payments for this house? Because I'm not just going to buy it and just pay the payments on it.
Because you don't know if you're going to make any money off of it.
That's where the wrap comes in. What I will then do is I find this seller that is behind on payments or unable to make the payments as they sit, and they no longer want the home and they can't sell it. I, as the investor, find this person, and then I, as the investor, I see if I can find somebody else that I could sell it to that would be willing to make payments on this house that has enough of a down payment to cover any of the past due payments. So I get this buyer to come in with a down payment. That down payment is used to pay off any past due payments, get any agents paid out. I then buy the house from the seller. I sell it to my buyer, and correct me if I'm doing any of this wrong. Right. I'm selling it to the buyer, and the down payment that I receive from the buyer goes to pay off any of the past due payments and closing costs, and any overage of the down payment, which can happen, now becomes my today money. I will close this transaction without any money out of my own back pocket. All I was the wizard that stood in the middle that understood how to make all of these things happen. While I did not have any money in my own back pocket, I was able to pair somebody that wanted to own the house and had a down payment, and I was able to buy the house and then sell it to them and create a transaction that created long-term future cash flow, created long-term future wealth, and also created today money to allow me to continue marketing to move forward. And that is what Grant has done in the last downturn that allowed him to just recently go through a hypothecation that is going to prepare him for the downturn we're about to hit.
Absolutely, and I'm so glad that you outlined it like that. And again, that's true. We're about to hit a break. When we get back, what we're going to do is we're going to talk a little bit about, okay, so that's a strategy, right? That's how you get in, right? How might, as both of us said, if we knew what we knew today back then, what would we have done differently? Okay, we're going to talk a little bit about what my portfolio might have looked like going into the last downturn, because that's what it's going to be coming into this one. As a quick reference, though, I want you guys know this is happening. This is real. I literally yesterday opened up title, sent my buyer to Texas Pride Lending, because I got a JV request from a viewer of Propelio Academy or Propelio TV who said, "Hey, I've got this deal that I don't know how it's going to work. It's kind of crazy. There's no comps. It's overvalued. There's no equity, blah, 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 blah." So he went to creativecashflow.com/JV with me, which I will recommend you do as well if you want a JV. We went out, we contracted the deal under a 90-day option period, marketed the property for sale, just found our buyer. We're going to net about $4,000 up front. We're netting $750 a month in cash flow on this deal, and it closes on Friday.
That's lovely.
It's
That's
awesome
lovely.
stuff that's happening right now and will continue to happen if you know how to handle it. So let's go to break. When we get back, we're going to talk about how might this next downturn look for you.
Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at Propelio.com.
You want to buy more houses. Here's Dar and his wife after only 2 weeks of being my mentor student. And here's Brady after paying attention to all our online videos and attending all the live Q&As. You want to buy more houses? 3 steps. Sign up at creativecashflow.com/memberships, watch all the videos, attend the live Q&As, and then send me a photo with you and your sweet, sweet new contracts. creativecashflow.com, helping you buy more houses for one low price of only
Welcome back, guys. I want to give a shout out to Jay Johnson. Nice, the process in layman's terms. I appreciate that, man. I'm glad.
That's what I bring to the table. I'm the stupid guy.
Shut up.
I mean, that's what I bring to the table.
No, that's not. I mean, what I'm glad about though, we're talking to cameras. We don't know what's going on the other side of this. So if you're getting value from this, or if you're a member at creativecashflow.com, or if you're a member of Propelio, please give us some social proof. We got a whole bunch of people watching here. Would you comment in there if you're already a member and you're getting value and you're enjoying it? Say one thing that you like about it, something that you have found value in. Our job is to remove as many obstacles between you and a success as possible. That is my behind-the-scenes drive at creativecashflow.com. That's the thing that drives every decision that we make for our career is how do I remove another obstacle that's between a new investor and having a big portfolio? This is a big part of that. Creative Cash Flow is a big part of that. Propelio.com, propelio.com/academy is a big part of that. I literally do give away on the Academy 36 videos, it's like 9 hours of a course. That is a deep dive into this. Now, if you want more, creativecashflow.com, we do a Q&A every Monday night where I just answer all the members' questions. Whatever you got going on, whatever you're running into, I'll help you analyze, or I'll help you run that through. I don't analyze deals on Q&As because deal analysis, to do it right, takes an hour plus. So, for our high-end students, the creative executives, we do a Thursday deal analysis workshop every week where I will analyze their deals, your deals, 3 times in a month. Once a month, I'll analyze one of my deals that's already been done. So you can see acquisition and disposition numbers, exactly how it worked with dates, timelines, budgets, all that kind of stuff to see what's really happening. And then we do a quarterly mastermind, which is coming up this weekend on Friday. So if you've been teetering, you're interested in trying that out, want to get into the mastermind, contact me now so that we can get that going. All right.
Question that just popped in. Is it easier or harder to find a buyer for a wrap when the market is down?
I love that question because this is something that we brought up briefly last week. I'm going to almost repeat what I said last week, but we can maybe have a little bit more time on it, which is when the downturn occurs, from a lending perspective, what's one of the first things that happens?
Credit dries up. It's hard to get a loan.
Does that mean that people don't have cash?
Absolutely not.
Does that mean that people don't want to be homeowners?
Absolutely not.
So what we have just seen is a massive increase in buyers. We've got people with cash who want to own a home who cannot get credit from a bank. Massive increase in buyers. What else have we just seen in a first downturn? We see from the seller side.
We see sellers that do not have buyers that can get loans to purchase their properties, so they're stuck trying to sell a property and no one can get loans.
So can Jimmy Wholesaler go in there and buy this house?
Jimmy Wholesaler can't go in there and buy the house because there's no discount to be given. The house needs to be sold at full value.
So if you were to guess, percentage-wise, the amount of people in this market, in the real estate investing world, who understand how to buy on terms with creative financing,
I'd say a single-digit percentage
Me
of
too.
real estate investors in the United States understand creative financing on any capable capacity.
I would absolutely agree with that. And I might even say under 5%.
I was leaning
honestly.
towards single digits.
Yeah.
Heavily
So-
leaning towards single digits.
How many of you, and I want you to comment here, how many of you comment with this if you've run into the whole, man, we had 12 offers on this house, people are offering stupid money, I can't even compete with this. I show up to a wholesale appointment, there's 8 other people there, blah, 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 blah. Imagine that, but imagine you're the only one who can possibly buy this person's home.
The only one. It's not even like they got 5 offers to look at. Yours is the only offer that can even come close to solving the problem. No other people know how to solve the problem. And that's where this knowledge has become so valuable.
So you extrapolate that out, you've got a massive increase in seller pool, you've got a massive increase in buyer pool. That is why this strategy is so important going to the downturn, is that you are the only one in that under 5%, and I mean that. I mean, it's probably 3% of the market can, and maybe 1% of the market does. You know what I mean? The creative financing stuff is not what everybody knows. So if you're that person who can capitalize on that, this is how you build your wealth. So we've talked about sub-2 wrap, right? That's kind of that early downturn. If we want to go back to this graph for a second, we'll show you. We're talking about doing sub-2 wrap. So when we get into this early downturn, which is where we're at right now, again, we're thinking we're right here. Now, are we saying that properties right now up here are worth 210 and right here they're going to be worth 80? Is that what we're saying?
What I am saying is no one knows. What I am saying is that, yes, there is the possibilities of that happening. If trade wars escalate with China, if we start seeing a potential shift in the IMF, in the default currency, blah, 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 blah. If major political things start happening in the world, there is a chance of that happening. Do I believe that is happening? No. Do I know what is happening? No. Do I believe we're moving to a change? Yes.
Absolutely.
How deep that change is an unknown, but the right knowledge applied with a steady look at the market leaves you prepared and positioned to win no matter what. You need to be a well-rounded tool belt. You cannot be a one-trick pony in a market that is volatile.
Absolutely. So I want to stress, we don't know what percentage of a downturn this is going to be. We also don't care what percentage of a downturn this is going to be. I want you guys to be ultra clear that I'm not sitting up here saying, hey, we're going to see $200,000 houses sell for $80,000 in 4 years. That's not what I'm saying. It could. It might. I might say we're seeing $200,000 houses that are going to sell for $160,000 in 4 years. Okay? That might be more like it. We don't know. We don't have a crystal ball. But what we do know is that there's a shift. And we do know that when there's that shift is when we need to take advantage of that. So as he pointed out a second ago, when we see these early downturns, yes, we want to take over in the sub-2 wrap realm because we are trying fervently to, A, mitigate our out-of-pocket, right? So out of pocket. The advantage to doing a wraparound mortgage, to answer Mandy's question, we always never accept less than a 10% down payment, which means you have the cash to transact that deal, okay? You don't want less than a 10% down payment because if they don't have 10% to give you, that is a default waiting to happen. In our world, get a 10% down payment. Always don't negotiate that.
Default waiting to happen is just another way of saying they're going to go to foreclosure.
They're going to go to foreclosure. We don't.
If they don't have skin in the game on that, they're not in it for the long term.
I'll tell you this right now. There are some Facebook famous folks right now, that's the biggest clue I'll give, who've done a lot of deals, owner financed, in this last 4 years since 2015 they got into the business. They look great. Everybody's worshiping them. I'm pretty scared for them. I know what their portfolio is, and it's not a portfolio. It's something that makes money, and it's a glorified time bomb.
It's a glorified time bomb.
So we want to be careful. We always get 10% down payments. We don't give crap as-is houses for a lesser down payment. That's not what you do. You build a portfolio, not a business. So we want to mitigate our out-of-pocket. We're going to see a lot of arrears, right? Mm-hmm. When we've got back payments, I need that down payment to cover my back payment. If I were to take that down sub-2, cover $8,000 worth of back payments and $10,000 worth of work and rent it, and then I'm going to net after your 24% of what's the word I'm looking for all the repairs and crap that you got to do, capital expenditures.
Okay.
All your capital expenditures and maintenance and repair budget that you got to factor in for rentals. You're not making money on that deal for a long time, right? Now, if you're in a position where you can afford to not make, here's my position on rentals, and maybe somebody will convince me otherwise someday. My position on rentals is if you don't need to make money on that rental, get the rental. Okay, that's the time to get rentals. If you need to make money, do some owner financing because that's when you net money. Okay, so we want to mitigate our out of pocket. We're going to be doing the sub 2 wrap. Here's something that I am going to be looking for. This is how I'm going to change my portfolio with my knowledge that I have today. Had I had it before, I did so. Well, let me finish that up. So we're doing sub 2 wraps in this area. I'm going to continue to wrap all the way through, okay? Where you start to see issue is somewhere in this stage 5, that sub 2 becomes challenging. Somewhere between stage 4 and stage 5, sub 2 becomes challenging. You got to kind of switch things up because people all of a sudden they have equity again. You're not their only option.
Credit is starting to loosen up a little bit. Short sales start really pulling through, allowing, because once you get down to stage 2, stage 3, a lot of these homes are significantly underwater. Stage 2, stage 3, shorts become extremely prevalent. Sub 2 is still definitely there because you're going to find the people that bought 7 years ago, not 2 years ago, and you'll be able to sub 2 them because they are now sitting at a point where they are no longer having equity. So if they bought at, over here and then the market went up here, well, as the market's still going down, guess what they still have?
Right.
Equity. But at the market hits here, they lose their equity, and that's where the sub 2s come through. But as you're going down this short, sub 2 wrap, and then as you start getting to the bottom, that's where I really think rentals should be considered because the rentals on an appreciating wave gives you so many opportunities to just exponentially grow that wealth.
Yep. So to that point, I've got some houses that I bought right here. In that 2012 or 13 to 14 range that I'm doing a hypothecation on. What's a hypothecation? Hypothecation is basically notes. It's called a million different things. Notes receivable lending. It's called hypothecation. It's called collateral assignment. Essentially, what I'm doing is I can't get a refinance on these houses because I don't own the house. I can't put the house up for collateral. What I do own is a note to somebody at 9.5% for 30 years. Right? I can put that up as collateral. So I'm getting a loan, which is going to cash my equity out on the deal, and my collateral for that loan is the loan. My collateral for Joe Loaner is my wrap note. Okay, so I'm capturing my equity. I'm paying 8%. I'm getting paid 9.5%. So I'm still making a little bit of money a month. Still capturing some back end. Blah 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 blah.
But you're getting a large capital fusion.
I'm getting
right
a large
now.
capital fusion that on taxes shows up as debt. So I don't have to.
You're not having to pay taxes.
I don't have to pay a bunch of taxes out on it, right?
So
I'm capturing my equity with debt, and essentially all that means is I'm taking less cash flow on a monthly basis, and I'm getting all my equity out.
And you still have all your assets.
And I still have asset control.
So there's a really big win there. Now that might went a little above and beyond what some people are understanding right now.
Advanced as hell.
That is a pretty advanced strategy, but we're trying to get you to the point that you do understand those advanced strategies. We actually have somebody watching right now, Troy Fullwood, one of the educators from the Propelio Academy, a massive notes guy, man. Troy Fullwood, if you see him over there, he's watching on Facebook right now. Reach out to him, say hi, say thank you. Thank you for all the contributions you've done to the Academy. Thank you, Grant, for your contributions to the Academy. Thank every one of y'all for the contributions, but we got some serious winners watching right now.
Yeah, for sure. Troy is, you never know on Facebook, right? You never know on Facebook. You never know the ones that are actually doing and the ones that aren't doing. And I am 100% against the goon squatting, calling out, this person's sucks or blah, 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 but 100% against it. That's not the way that we're going to run our business.
Got another good one on here, Jaime.
Jaime, yeah, there you go. Jaime knows how to analyze some freaking deals. So, but Troy, he's the real deal. We'll vouch, right? All right, so what would I do different? I'm bringing up that hypothecation to bring up that why I'm doing it the way I'm doing it, okay? This is meaning that I'm going to capitalize part of, again, when I say that 5.5 that I'm netting out of that portfolio, that's included in that. But that's going to put about $400,000 to $500,000 into my pocket off of a package of about 14 notes that allows me to go back out there. As I'm doing this hypothecation, though, I started having to, because I wanted my lender who is not super familiar with hypothecations to understand kind of what situation they're getting in. So I went through and I comped using Propelio. I comped all of the properties. I got current comps for all of the properties in this. There's 17 houses in that package, 3 of which are not wrapped, 3 of which are that I'm basically refinancing. So there's 14 that I'm doing a true hypothecation on. On those 14, I would have made, if I had rented those, today's value of them is, my net worth would be 50% higher.
That's huge.
Than it is with the note net worth that I have. Does that make sense?
Let me recap that. So your strategy through 2012 to 2015-ish, 16-ish was purchase property subject to and sell them on a wrap.
Mm-hmm.
So the asset that you retained through this time was your note, your bank
Correct.
note, the note that somebody says owes you money. That is how you transacted the whole thing.
Yep.
Nothing wrong with that. You've established a serious net worth out
Yep.
of that. You're right now about to pull down a solid hypothecation that's going to put a big chunk of cash into your capital for moving forward into the next phase. What you're saying though is that by looking at these assets, that if some of them you chose not to sell on a wrap and instead purchase them subject to, we consider subject to an acquisition strategy.
And that's I want to repeat that a million times because too many people don't separate these strategies. You can sub to and list on the retail market. You can sub to and rent. You can sub to and wholesale. You can sub to and wrap. Sub to is a way to get into properties.
So we sub to wrapped all through 2012-15. But now that we are sitting here in 2019 and you're looking at your portfolio, you're seeing a lot of properties in your portfolio that saw a massive appreciation because you got them down here at the bottom, and while the market was doing this, you still had solid cash flow from all the notes you generated, but you missed out on the asset appreciating like this because you didn't own the real estate,
Right.
You owned the note.
Right.
So what we're saying is that you might have considered maybe doing some of them as wraps and possibly doing some of them as rentals, because if you held the rentals, you purchase it sub to and then rent it, the renter should be paying the house payment for you. You'll have to deal with the toilets, tenants, and trash. But if you would have held that through, you would have seen a 50% increase in your net worth just by changing up how you were disposing of the asset.
Absolutely. And so one of the things that I want to point out, so I brought this up in episode 1 of this series, right? So I think this is our 3rd episode in the series, isn't it?
This is our 2nd episode.
Is this the 2nd episode of the series?
The first one was a breakdown of the markets themselves and the things that caused the markets to move.
That's right.
This one is phase 1.
That's right.
Next one we'll talk about phase 2, and then we'll talk about phase 3 moving forward from there.
Perfect. That's right. So I brought this up last week in that there are so many ways to analyze a cycle that we've been talking about, market cycle, but what we're not talking about is career cycle. You can also apply these same principles to a career cycle, because I do not regret that I sub-2 wrapped all of those. I was eating chunky soup. I did not have the ability to manage a portfolio of 100 houses in rentals, okay? That's ridiculous, trying to manage. And if I had done that, I would have been accepting 8 to 10% less on the payment because of management fee if I was going to try and do that, right? So you've got your manager's fee taking 10% from you. So now all the cash flows that were coming in aren't, right? Now all of the net, I did my work for 2 months and I can count on money happening for the next 20 years is gone. With rentals, you do your work for 2 months and you can count on money happening maybe next month. And then in a year, you might have a vacancy. You might have, it's all going into tomorrow's and that kind of stuff. So where my position was then is like a lot of people who are watching now. Who watching now, I'd like to know, because again, and I say this maybe too much, maybe not enough. Our job is to know you better. Our job is to offer the best education that you can possibly get on this. So I need to know where you are. If you were watching, every single one of you that's watching right now, I need you to comment on this. Are you more like Daniel and I were when we quit? We'll say that's stage 1 of your career, okay? Or are you more like where Daniel and I are now? which might be stage 4 of the career, right? If we're taking a 6-stage cycle. Because I'm going to match my stages in the 6 stages to this, understanding that, guys, I'm going to work this next 7-year cycle and I'm done. That's the reality of it. I'm
in the same boat.
I might keep doing this stuff because I enjoy training. I enjoy doing this stuff. I might keep doing this. This next 7 years, I'm busting my butt and I'm done, okay? So I'm in that stage 4 of I understand what stage 1 looked like. I understand what it takes and the hard work that it gets to get here. I understand all the mistakes we've made. And we're going to reapply for this next part. And my stage 6, when I'm applying this, stage 6 to me is you can retire. Not you will, you can. Stage 6 in my career cycle means if I so choose to say I'm never going to pick up another phone, I will make as much money as I want to make for the rest of my life and my grandkids go to private school. That's stage 6 to me.
Let me answer a question for someone that had it. Travis Jones says, could you explain a note in a little more detail? I'm going to answer that question while we have more people in the audience chime in on their current stage. What we mean by a note is we are going to give the people the house. In exchange for us giving them the house, they are going to promise to make us payments moving into the future. And the note is the document that says, you are the borrower, I am the lender, you need to make these payments to me, these are the amount of payments, this is how often I'm supposed to be paid, this is where I'm supposed to be paid, this is the interest that I'm getting paid. That's the note. It's that piece of paper that outlines the fact that I'm giving them something in exchange for something in the future, which is more often than our cases, we're giving them a house for exchange of payments moving into the future. That is the note. The note, and I'm going to answer this while we're here, should also have a security instrument attached to it. That security instrument is the piece of paperwork that allows somebody to file a foreclosure if the payments are not made. So those two documents, when we're dealing with real estate, are almost tied together. The security instrument, which will either be a mortgage or a deed of trust, and the promissory note or the real estate lien note are going to be combined together, and that's what's going to give you the power of paper being your asset. So the things that he was creating as assets were these notes.
Absolutely. Thank you. Note is a mortgage, right? Debt on a property, securitized by something that lets you foreclose on them. Thank you for detailing that. So we got a lot of 1s, couple 2s. Edwin's a stage 0.5.
We've all been there, man.
Absolutely.
We've all been there.
So that's educational for us. Now, we're going to take 2 stances on this, and I'm going to take my stance that I'm pretty sure Daniel will disagree with, and then we'll see if he does or not, okay? My stance is, if you're in stage 1 or stage 0.5, we're coming into this next cycle, this stage 1 early downturn.
I'm already disagreeing with you. Already disagreeing with you.
I'm going to really encourage you to go heavy on the sub 2 notes. I'm going to really encourage you to go heavy on terms. I'm going to really encourage you to make sure that you're building out a portfolio of sub 2 wraps, as I did, because looking back, this is the beauty that we have as we're peeking into this or peering into this next curve, is that we get to now look back at a full market cycle, which I didn't have the experience of doing before, right? And I get to look back and I say, how did that cycle work for me? Do I like how that went, or do I want to change how that went, okay? I will tell you, from my perspective, my 7-year plan here, I'm going to do 750 sub 2 wraps in this next 7 years. I need forever money. Rentals are forever money, okay? Forever money is, the sub 2 wraps are going to last you a maximum of 30 years. I'm 33 years old. I plan to live longer than that, and I plan to have kids, or I have kids and maybe grandkids, right? So I need forever money. My forever money is going to be in commercial. Specifically for me, probably storage units, okay? I'm still not a massive fan of rentals, though I will be picking up a few rentals a year, purely for tax depreciation and purely to have a little bit more forever money capability and to have that appreciation hitting my pocket. If you're going in as a stage 0.5 or a stage 1, my recommendation, be heavy on terms and find somebody, if you want to get into rentals, which I think is a good idea, but I think if I was going to say rentals to wraps, maybe a 1 to 10 ratio. If you're in your stage 5, stage 1, is that agreeable enough?
I would say it depends upon the market cycle. Because if we are in stage one of the market cycle and you are in stage one, you do not need to be doing any rentals at all.
That's what I'm.
Because the market's too risky. I think sub 2 wraps should be the only thing you should be considering in stage one market cycle. And if you're in stage one of your career, I don't even think you should be considering that either, unless you have a stage 3 or 4 in your corner.
That's where I was going.
And you must have a stage 3 or 4 in your corner, because what we're talking about here with this creative financing is not a wholesale transaction. Benefits of wholesale transactions: minimal risk, in and out of the transaction, boom, boom, done, paid. Subject to is a lifelong transaction. This is a 10, 20, 30-year long transaction.
Where if you screwed up the paper on the first part, you could be possibly screwed for up to 30 years.
And if you screwed that paper up on the front side, you could possibly be screwed for 5 to 10 in prison type of stuff. So it's serious stuff. You really do need the right person in your corner. And every market has probably got a prominent person in that market that is this guy right here.
Well, which, and Scott Horn was mine. I want to be clear that we're not saying go do something we would. Scott Horn I stood on his foundation. That's why it was comfortable for me to buy 6, 7, 8, 15, 10 houses a month, because I knew that I had somebody in my corner who had been there, done that, and if I screwed something up, he would tell me and we could fix it.
Yeah.
Right? Daniel came to me for that.
You were my corner, and you still are to this day. Yeah. Anytime I go to do a creative financing deal, I always lean back on him and say, double check everything I just did, make sure I'm good to go. Mm-hmm. It is important. Our paperwork to knock down a sub 2 deal on the acquisition is like 36 pages?
39 pages plus the 9-page trek.
39 plus the 9-page trek, and then the closing documentation on the backside is another 130 plus pages. And this is all legal drafted documents. These are not things that I suggest you just go out and do on a whim on some paperwork you download off of Carlton Sheets' website. We're not going to do that. But I am saying that if you are moving into a phase 1 downturn cycle, sub 2 wraps is the position to be in. And if you are a stage 1 investor, find a stage 3 or 4 investor like Mr. Grant Kemp and both win together, because he did all of those deals with another stage 3 or 4 guy.
He's on stage 90.
Yeah, that dude's he's been through 20 plus years of market cycles. He knows what he's doing.
Yeah.
That's where I'm at on that.
Yeah. Okay. So we do agree then. That's 100% where my stance is I was getting so hesitant because I was ready for you to tell me that I was dumb for telling them not to do rentals. Don't do rentals. If you're in your first stage and you're getting into this early downturn, just do the sub 2 wraps, because you don't have the ability to follow up with that rental the way that it needs to be followed up with for it to make you money. Wait till you get down here. Now, the exception I will make on that is if you hit a couple of rules of thumb on the rental. 1, you're sub-2ing with no money out of your pocket. They're not behind. They just want to get out of the deal, okay? So all you have to pay is closing costs to get into the deal. So you're in for $1,000, $2,000, something like that. Run into those all the time, okay? People watching these videos say, that doesn't happen. It happens. People give me their house. They're not behind on payments. They're just smart enough to know they're about to be behind on payments if they don't do something now. So you get into a house that is sub 2, that does not take money for arrearages. Second rule of thumb is that the payment PITI to that house is less than half of the rent rate in that house, okay? If your payment is less than half of the rent rate is the first point in time in which you might accept some cash flow from a rental, because that can afford you the repairs and the property manager and that kind of thing.
A rent ratio of 2?
Rent ratio of 2. Yeah, I mean, if you can get a rent ratio of 2.
That's what you're saying here.
Oh, yeah. No,
we're looking for a rent ratio of 2. And what he means by PITI is principal, interest, taxes, and insurance are half of what they would rent for, which is a 2% rent ratio. Underneath those standards, you would suggest in a phase 1 downturn, in a phase 1 market cycle, to acquire rentals.
I would say that I would be okay with you doing it. Okay. I would not say that you should. That is what I'm getting at. If there's somebody out there who's just dead set on rentals, and they're like, Grant, stop telling me not to do what I want to do, I'm saying at least follow. It's like the parent who's like, don't have sex, but here's some condoms, you know?
Well, this is where I would jump in. No matter who you are, I do not, under any circumstances, personally recommend doing any rentals at all stage 1. The market is dropping too fast. You're leaving yourself with such a slim equity margin that if the market continues dropping, your only disposition strategy now is a short.
Right.
I don't want to put myself in that situation. If I am this person, I hold off on any rental acquisitions until stage 2, and I have certain criteria that I'm expecting to meet stage 2. The only acquisition strategy I would be employing at the turn of the down cycle is sub 2 wraps.
Yeah, and I agree with that personally. And I would also say I'm even more conservative on the rental. I'm waiting until stage 3 before I do any rentals.
Okay.
So that's kind of where I'm at, right? I implore you guys, rentals are not what people think that rentals are. Rentals are great. They're not what people think rentals are. Wraps are what people think rentals are. And it means that you do work and you get paid, and that's that, right?
Let me throw in, because I think we're getting towards the end here,
We are.
and we're
Yeah,
going
we
to be
gotta wrap
talking
up. I got a meeting.
specifically about stage 2 on next week's episode. If you're enjoying this episode, next week's episode on Wednesday is going to be talking specifically about stage 2. Stage 1 is exactly where this man performed. Sub 2 wraps, killed it, made a huge portfolio. Let's talk about stage 2 on the next turn. Stage 2 is going to be where we start talking about shorts, sub 2 rents. Sub 2 wraps will still work in that area. You need cash money today. You need cash for tomorrow. We need to blend our strategies together. Stage 2, though, in my opinion, strong on shorts. Maybe we can get an awesome person in here, Melody, to come in here and talk while we're in here on stage 2, but we'll move through on that. But one of the things that I clearly want to highlight from my perspective is we need to be aware of what works best and when, and that is what we're focusing on trying to teach all today. Grant has done a really good job of teaching subject 2 and wraps. Moving into next week, we're going to talk about shorts and sub 2 rentals. Mm-hmm. Where I'm at with rentals is I need to rewind back to the first episode.
Yeah.
I am consuming, as Mr. what's the freaking phenomenal, Warren Buffett.
Yeah.
Warren Buffett always says, when people sell, I get greedy. When people get greedy, I sell. Stage 6 is people getting greedy. That's where you need to sell. Stage 3 is when everybody is selling and I need to get greedy. Why am I getting greedy at stage 3? Why am I trying to buy massive amounts of rentals at stage 3? And I'm going to explain this to any rehabbers that are watching this show right now. Rehabbers are struggling to find solid 70-cent deals that are repeatable enough that it creates the income that they desire. So to create the income that they desire, they are taking larger volumes at smaller margins, which are risky as all hell. Mm-hmm. If I consume and I eat a ton of rentals at stage 3, when stage 5 and 6 come out, I have already purchased my rehab portfolio 6 years earlier, 7 years earlier, and now I can absolutely slaughter. I can go out there and make millions and millions and millions and millions without having to do a ton of work. At the bottom, everybody's selling. It's easy to get these assets at a discount. At the top, no one is selling. It's hard to get the assets at a discount. I was the wise investor that built my portfolio on the bottom so I can cash out at the top and prepare for the next downturn. That is what I'm trying to get everybody to see as a holistic approach.
And to reinforce that, that is how my portfolio has worked out. It doesn't have to be rentals to get greedy at the bottom and sell at the top. Note sales, hypothecations, those kinds of things can give you similar responses. So all of you stage 1 folks who hear us talking about we're going to get greedy on rentals and selling at the top, we're in a different stage than you are, okay? Be aware of that. You can still get into a lot of those same benefits without risking a lot of the risks that you have to go in. Now, I understand. We're talking stage 3. There is still rentals in there. We'll get into that in 2 weeks. But back to this graphic right here, just as we finish up, we want to point out what Daniel was pointing out with Warren Buffett is we are going to get greedy at the bottom. Tommy, can we get back on the graphic? We're going to get greedy at the bottom. We're going to sell at the top. I take a stance, which we may debate over the weeks here. Regardless of what area of the cycle I'm in, I need to see these LTVs, okay? Regardless of where I am, I'm not going to consider certain strategies without certain LTVs being hit. The beauty about this deal right here is that you can go one way on this. Actually, I don't know if I can do this here with the, yeah, no, I can't do it. If you get a deal at 70 cents, you can still hold it or own or finance it, okay? You can go one way on this chart. But if you get a deal at 85 cents, don't hold it, don't wholesale it, don't flip it. You can only own or finance it, right?
I totally agree with that. Anything you acquire at any cycle has to be a deal at that cycle. We do not hypothesize about the future. It must be a deal the day we take it down.
We're not speculators. All right, guys. So that's our stage one for you today. This is something that's very important for y'all to understand. Daniel wants to.
I have one final plug.
Something I said.
No. I have one final point though. I will be speaking on this entire thing holistically down at Wholesaling Live October 4th, 5th, and 6th in Houston, Texas. Wholesaling Live, if you have not got your tickets yet, I believe they have some serious deals going on right now. But one of the things that I'm going to be releasing at Wholesaling Live, and I'm not going to discuss until after Wholesaling Live, be there to hear it in person, is exactly how, no matter which stage of your career you're in right now, stage 0, stage 0.5, stage 1, stage 5, how we can all join together and win together. I am going to show you in Wholesaling Live how all of the people that rang in here as stage 1, you need to be at Wholesaling Live. I am going to show everyone in the crowd exactly how stage 1s stand next to stages 3s, 4, 5, and 6, and how we all come together and make millions and millions together. I'm going to show that at Wholesaling Live, so I wanted to throw that out there. I don't want anybody watching right now that's a stage 1 scared because they haven't found their stage 3, 4 guy yet. I want to show every one of y'all how we're going to build this out so we all win together.
Absolutely. Thank you so much. I really look forward to hearing what you got to say on that.
Let's get some thumbs out there. Let's get some thank yous. Let's
Please
get some
share
highs.
this. Please subscribe. We want to see this number go up there. I think that we've given you guys massive value, and if you guys can't pay us back with a subscription or a thumbs up, that makes me really sad. Make sure that you are at Quentin's meetup October 15th in San Antonio. Daniel's going to be there as well on that one.
I'll be speaking there. I'll be speaking at Quentin's meetup there on October 15th. And I'll be speaking at Antoine Campbell Sr.'s there, National Harbor in Maryland, October 29th. So if anybody's in those areas and would like to hear and get a chance to meet, we'll be there. We'll be chopping it up. Don't forget to download the Propelio mobile app. It's available on iPhone and Android. Go out there, Propelio Mobile. Driving for dollars. Driving for dollars will get you out there and get you going. It is a great way to get into this market right now and compete with people that have bigger marketing budgets. I'm done. Thank you all for being here. Thank you all more than I could ever express. Yeah. Thank you. Thank you, Grant.
Amazing.
And
we love you guys. We'll see you next week.
Have a good one.